All right, in the last video, we left off talking about decision making as an institution and how we have the market versus planned decision making. And this brings up the role of government because if you're going to move towards a decision making structure that is planned, you're going to increase the size and influence of government. If you're going to move towards a decision making structure that is market, you're going to lessen the size and influence of government. And a good way to see this is in what we call a circular flow model. Some of you may have seen this model used in other contexts. But we separate the nation down into firms over here, okay, and households over here. And households and firms interact in product markets and in factor markets. Just ignore government for the moment. So what does this interaction look like? Well, households make their factors, their land, labor, capital, available to firms in factor markets. And firms pay them for those factors. So you have this flow of factors, land, labor, capital, to firms, and then you have the money flowing to households for those factors. Things like wages for labor, rent for land, interest for capital. Up here in the product markets, you have firms which are providing goods and services to households, and households are paying for those goods and services. So you have this flow of, physical products, and then you have the money flowing to firms. You actually have two flows here. You have the clockwise flow of factors going to firms, and those firms turning those factors into goods and services that are flowing to households. And then you have the counterclockwise flow of payments, which is dollars flowing to firms for products, and then those dollars flowing to households for factors. Absent government, this would be the economy. However, once we introduce government, which we always do because government is the political institution that provides support for many aspects of life that the market cannot. At the most basic level, the government exists to provide protection from others, and the market historically has failed to do that. So government always spawns in nations. It's a matter of how large it's going to be. And back to the question of, is it going to be more of a planned economy or a market economy in decision making? So by adding government into our model, we're going to change the flows a little bit. For example, we know that when these payments, wages, rents, interest, are flowing through the factor markets to households for their land, labor, and capital, in essence, when the firms are paying you your income, some of that income is going to get diverted to government. That's how government pays for itself. Government doesn't have any resources of its own to generate income, so it uses the power of taxation to acquire the means to spend in the product markets. So you can think of government as somewhat of an intermediary between firms and households. Markets are just about firms and households in the most basic sense. When government gets introduced, we move more towards planning. And that's okay. As I said, government is a necessary entity in a market system, but it does take us one step away from a pure market form of decision making and moves us to somewhat of a planned economy. And another way to think about this is the extent of taxation is going to influence how much planning goes on, or the ratio of market to planning. If, for example, as firms are paying you your income for your factors, let's say the government takes 10%. Well, that would be a relatively small government, and market decision making would be much more influential than planning. But if the government takes 90% of your income, then that would be very little market decision making and a lot of planning. Remember, market decision making requires that households get their income and then go up here and purchase things in product markets based on what they desire. If the government is taking that money from you in the form of taxes, you're not able to participate in those markets. So the government is now planning the economy. This is a simplistic model, but it gets us thinking about this decision making process. And taxes are a good way to understand it. If we were to look at extremes that don't exist, we could say a country that has no taxes cannot have a government, which means all decision making would be based on market forces. But a government that has 100% taxes would completely eliminate market decision making and would be a perfectly planned economy. Okay. All right, so just another angle to look at the decision making. The next type of institution we're going to talk about are incentives. We already learned that there is a principal-agent problem in hierarchical organizations, which are the norm. Therefore, agents have to be incentivized to align their behaviors towards the principal's goals. If, in my previous example, you give 20 bucks to your roommate to go shopping for you, well, you are the principal, they are the agent. How do you get them to buy stuff that is in your best interest and not just spend it on themselves? That's another way of saying you need to incentivize them to purchase things that align with your goals, not their own. And it may be as simple as they want to get along with you, so they're going to buy stuff that you want. But in some cases, that may not be a strong enough incentive. So you have to work harder as the principal to get the agent to do what you want. Incentives can be powerful, but there's three things that need to occur in order for them to have that power. First, the agent must actually be able to influence the outcome for which the incentive is given. If I'm your employer in a restaurant and I say to you, hey, I'll give you an extra, $10 if you go and sweep the customer service area. You'd say, well, okay, sure, $10 more. I'll go and sweep the customer service area. I can do that, right? I can influence that outcome. But if I say, hey, I'll give you an extra $10 if you go and retile the customer service area. Well, I don't know how to tile. I can't do that. So in that case, that incentive would have no impact on the agent because you're asking them to do something they can't do. It's just like if I said, I'll give you $1 million if you go and, pick up my car and lift it over your head. It has that $1 million has no incentivizing effect because you can't do that. Okay? The second thing is the principal must be able to verify the task the agent has been able to perform. If I tell you as the manager of a restaurant to smile at every customer, well, I can verify that because I can see whether you're smiling or not. But if I tell you, hey, I want you to make every customer feel better, be happier, I don't really have a way to verify if you're making the customers happier. See the difference? And as a result, I wouldn't be able to monitor whether you've accomplished the goal or not, and therefore the incentive would not have the same effect. I mean, simply put, if you tell an employee to make customers happy and you'll give them a bonus if they do, the employee is going to say, well, how are you going to know if I made them happy or not, right? And then the reward punishment has to matter to the agent. If I say, I'll give you 10 bucks to go and sweep the floor, you might do that because that matters to you. But if I say, yeah, I'll give you a dime, 10 cents if you go and sweep the floor, that might be an insufficient reward for you to actually be motivated. So the reward or punishment has to matter to the agent. Okay. There are three types of incentives that we want to consider. Material, which involves cash bonuses, higher salaries, a greater claim over material goods. You get more stuff with material incentives. Moral incentives, in contrast, are appealing to people's sense of responsibility or social status. I give you a medal, or I give you a promotion, a new title with more prestige, or I just praise you. Hey, thanks for doing that. Those are moral incentives. And then punitive is where we kind of use, right? These are the carrot, and this is the stick. Unemployment. I'll fire you if you don't do this. Or the gulag. In the Soviet Union, they used to put people in jail for not meeting the requirements of the leaders, not meeting quotas or not doing your job, that kind of thing. There is a spectrum here with all countries having a mix of incentives. Certainly countries that tend to be more capitalist in their property rights and more market in their decision making gravitate towards this end of the spectrum, the material rewards, right? And moral. I mean, a lot of people in the capitalist market systems, they are motivated to get up and go to work every day and do what their boss says because they want to move up in the company, right? Moral. They want the praise, they want the prestige, and they want the money. Right? They want to make more money and have more stuff. Whereas when we look at countries that are more socialist and more planned, they gravitate towards this range. There's still a lot of moral incentives. You should do what's right for the collective, right? You're part of something larger, and you not working hard hurts everybody. That kind of moral sentiment, more collective versus individual. But also, if you don't do it, we're going to sanction you in some way. And part of the reason for this is in the socialist countries, the planned countries, they don't like to use material incentives because material incentives create inequality of income. If some people get bonuses for doing things, they're going to have more income than the people that don't get bonuses for doing things. And that creates the very problem that a lot of socialists have with capitalism. That there are these strong material incentives, but that comes with inequality. So they kind of chop this off as an incentive, and they're left with moral and punitive, which means they have a limited range of means to incentivize people to work hard and to actually get the job done. Whereas in the capitalist market countries, we have all three of those, right? If you go to work, you can make more money than other people, right? That's a material incentive. You also can get praise and upward mobility. That's a moral incentive, but you also could lose your job. That's a punitive incentive. So we have a broader array of incentivizing mechanisms than a socialist planned economy would. The next institution we're going to look at is that of public choice. And this has to do with how government power is determined. Going back to this slide here, remember we have income flowing through factors markets to households, right? Firms are paying their workers, they're paying for these resources, but some of that income is diverted, leaks into government through taxes. The question is, where did the government get its power to tax? How much power does the government have? And the answer is, it depends. Some countries are autocratic, also known as dictatorships, oligarchies, or totalitarian governments. This is where decisions are made by a single governing entity unaccountable to the people. North Korea and Cuba are examples of that, and China. Democracy, in contrast, is where decisions are made by the people. They're either done directly, where we vote for various propositions, like when California legalized marijuana, that was a majority vote that made marijuana legal. But more often it's through representative democracy, also known as a republic, which is where decisions are made by elected representatives. Most of the decisions that our local, state, and federal government makes are not us voting on those particular policies, but instead our elected representatives voting on those specific policies. All right, we'll pick up there in the next video. Thanks.